So today's cardinal lesson, we're outlining for you actually a couple of solutions of what we're going to call the long-term care starter plan. And we're doing this, we've had people beating our door down over our last several videos where we talked about the way you take from $200,000 to $300,000, sometimes $150,000 of IRA money or of pre-tax money, and plop down a chunk of it and you buy long-term care insurance, and it could pay out 6, 7, 800, 900, $1 million or an unlimited amount for long-term care. And then if you don't use it, it would pay out to your children or your beneficiaries a substantial life insurance. We've had just people beating our door down and purchasing that, which we're very happy about. And what I've thought about, there's more people that have come to us or in the process of our financial planning, and we've suggested and recommended something like that. And they haven't outright rejected it. They just kind of go away. I'm not putting that much money into it. And we'd like to have a way to get back at those folks and say, you know, if you, that was one way to take care of the problem. You don't accept or reject that. We've got some other solutions where you can pay by the month and get yourself some basic protection against this real big problem and threat to your retirement planning. And so before I talk about these starter plan solutions, I want to bring Tom in, and I want Tom to talk a little bit about what exactly problem is it that we're solving here.
Sure. And so we have show notes in the link below in our video. And so you can find these documents we're about to look at down there. It gives a little more context of what we're talking about here. But initially, this first page is really defining the problem of what the cost is that we're trying to solve for. And so Genworth runs this cost of care study across the country where they look at actual claims data, so real people paying claims, and they put a cost to what these different levels of care cost. And so we can see assisted living here in today's dollars is $4,500 a month. Home health care is around, just under $5,000 a month, similar price there. Nursing home is much more expensive, anywhere from $8,000 to $10,000 or so. And then we can project forward of assuming an inflation rate of say 3% of what that cost is in the future. So really trying to define what the cost is, what the risk is to the people we're doing financial plans for. I will point out that oftentimes when we're doing these plans, we're really planning for a home healthcare or assisted living facility situation. That's where most people would prefer to receive care as opposed to a nursing home. It's less expensive. If they are to go to a nursing home, these plans will work there as well. If it doesn't cover the full cost, they can pay out of their income or other investments to cover the difference. But this really gives us an idea of the cost here. And so that's the first page. The second page is a 36-page document where Genworth has put a study together that really shows the impact for the caregiver. So this is adult children generally, or a healthy spouse. How does providing this care affect them? Because without the planning, that's really who takes over the burden of the care. It's your children or your spouse. And so we're not going to go through the whole report, but we're going to look at a couple different pages that I think really brings out some important things to consider. And so the first one is on page 5, which really defines, what has happened that is causing them to need care. And the reason I want to talk about this is oftentimes we'll bring up needing care and we'll have people say, I'm healthy. I don't need that. I don't have any health conditions that are going to cause this, which is great. We love that you're healthy, but those are really the people that are mostly going to need the care. As we can see that age-related physical limitations, it makes up 40% of the reason people need care, 47%. And so you are healthy and you've just gotten older. That's just normal aging processes. You can't do the things you used to be able to do. And so those are the healthy people that need it. And then the next highest one is at 32% is cognitive impairment. These people who have lived long enough, they have lost some of their mental capacity and they're needing care. And so those are the two highest reasons that people need it. It's not a health condition. It's not a stroke. It's not anything like that. It's really just normal aging process of you needing care. And so it's really the healthy people. I mean, everyone needs to plan for it, but I think the pushback of like, I'm healthy, I don't need it, is really just a false sense of security there. And a lot of it has to do with just denial, or just not wanting to acknowledge the fact that you might need this at some point in the future. The next one we're going to look at is down on page 24. And so let's see here. And this has to do with how caregiving impacts the caregiver's employment. And so this often is going to be the adult children. And from the study, 51% of the respondents have said that it has negatively impacted their employment. So this is adult children who are still working, having to provide care for their family, and it's impacting their current work. And that's going to be right in their peak earning years, right when they have, children going to college or having to worry about, and it really impacts them, can impact them pretty heavily. And so a lot of the planning that we're doing, it is for you to provide the care for you, but really the reason we're doing the planning is to prevent your children from having to step in and provide that role. Because ultimately, if you get sick, someone's going to provide the care. If you haven't thought that through, that's going to be your adult children, that's going to be your spouse, and it's really could negatively impact them, not only from a time standpoint, but from a money standpoint, from just a stress standpoint. I mean, there's a lot of statistics in this report. So if interest to you, I'd encourage you to read through it, because there's some pretty interesting things that they point out throughout the whole study.
Well, thank you, Tom. And, what I want to say about all of that is this is the main reason we see that disrupts and crashes retirement plans, is if all of a sudden you're facing some point in the future, $6,000, $7,000, $8,000 a month, every month for years, that's going to, I don't care how much money you have, that's going to be disruptive to your family, your financial situation, the whole thing. And so that's why we're such proponents of looking at your whole financial picture and taking a piece of those assets, and namely the IRA money, and apportioning that to get a policy that takes care of that. So, but that's not what we're talking about today. I'm going to show you a solution that is pretty good. And it's got a maximum of $210,000 of benefits that are going to be paid out for either assisted living, nursing home, or home health care. Okay. And what I've shown is the prices here for a 64-year-old female, a 64-year-old male, which is $4,500 a year for the female, a little under $400 a month. For the man, a little more than $250 a month. So men are a lot less expensive than women, because we don't last as long once we're needing care, and we don't have as high of an incident because we don't live as long. And then when you buy this as a couple, you get a 15% discount just built into the plan. And when you run the numbers on this $7,500 a year or $650 a month doesn't reflect a 15% discount of these two numbers added together. And the reason is in the couple premium, I've added what is called shared care. So if you're a couple, you're both 64, you buy this plan, and one of you uses up all of their benefits, you can go over and use the other spouse's benefit. Or if the one person passes away without using much of their benefits or any of their benefits, then the other one lives on with the remaining part of their benefits plus their whole benefit. So it allows you to take the two policies and put them together, and that pretty much eats up the couple's discount. But the whole idea was really, if you run all the math on this, it's a 2-year plan where it will pay out $8,400 a month of benefit. And that $8,400 a month of benefit is like $280 a day. And the $280 a day will pay out for essentially 2 years. Now, most people in today's day and time, or if you use it in the next few years, and especially if you use it for home health care, you're not going to spend all of $8,400 in a month to get home health care. If you go back to the chart that Tom was showing you, unless you're having a lot of home health care, it's certainly more than 4, 5, 6 hours a day. So if you don't spend all the money in a given day, the thing is going to last longer than 2 years. Now, it also has a very nice benefit on it where it'll pay you $2,000 a month of cash benefits so that you can hire your kids or hire a lady from the church, or you can set up your own plan and you don't have to go through an agency, and you're going to be given $2,000 a month or your policy in just cash where you don't have to send in receipts. And so that's going to use the policy up at a lot slower rate. And you just have to qualify for the care. They're not going to easily send you $2,000 a month in cash. You're going to have to show that you need it. You're not going to have to show that you're getting it. You're just going to have to prove that you need it and have a plan of care written out. Now, the elimination period on this plan is 0 days, and that comes from me a little bit. I've been offering long-term care insurance like 35 years, 40 years, and so I've dealt with a lot of adult children when their parents are claiming. And if anything really gets next to them, it's those 90-day elimination periods or 90-day deductibles that we tended to sell on the old policies, because our thinking was, well, you can afford this for a little while. Let's make the policy less expensive by putting a 90-day elimination period. I've kind of reversed that now in my old age, where I'm recommending these, where I go with a lot of 0-day elimination periods, because I like the policy to begin paying immediately. When you get to that point of using it, I want you to get paid. And this particular plan, or something very similar, is available in all 50 states in the District of Columbia. And we work in all 50 states in the District of Columbia. So if you want to get on the phone or set up a Zoom meeting with me and you want to talk about this, or perhaps if you're calling us talking about Medicare, we can do this all at the same time. We can get you started in one of these starter plans. Okay. So now we're going to move over here and we're going to talk about another solution that is less expensive, and it doesn't pay as long and it doesn't pay as much, but it's certainly very popular for people that are wanting to start a starter plan. And it's called short-term care. And I just have it abbreviated because I only get so many words on my board, but it's a short-term care plan. And this is the most popular one that we have. And we have a particular client who was trying to buy one of those hybrid long-term care policies for he and his wife. And he, because of some health conditions, got turned down. He wasn't accepted. And so he wasn't real happy about that. But nonetheless, we have to deal with the insurance company. And particular company we use, he had some very serious conditions. They said, no go. So it was rather difficult to convince both of them to buy it on her for less money. I think it was about $175,000 of IRA money. Bought her that big plan with a lifetime benefit on it. So she's very happy about that. And then they repositioned some of their other assets into an annuity that we talked about on a previous show, where this annuity will come in once they start the income. And if they need long-term care, if he needs long-term care, it'll double the benefit. And so it's a little complicated. You can go watch that video if you want to know how it works. But there's still quite a few limitations on that. And there's no health underwriting. That's why he was able to do that. And he was going to set up the income annuities anyhow. And we really don't want to start the income and put the doubler on her because she's got the other insurance. So anyhow, we were just meeting with him this week, and we sold him this plan, and he is 64, and he paid us $2,061. And you say, well, how'd you sell him this if he got turned down for the other one? Well, the health questions on this plan are easier than they were on the big hybrid policy, and much easier. And before we even talked to him about it, we read all the questions, and he could answer them all no. And so we just filled out an application, but it was kind of difficult to convince him to do this. But once they saw this and they saw that it's going to be difficult to turn on that doubler rider on the income annuity, and we're not going to want to do it if it's a short-term stay, they went for it. And once he saw the price, he went for this thing. So let me show you what it pays. It pays $300 a day. And the $300 a day is for 360 days in either a nursing home or an assisted living. And this policy has a cash benefit or an indemnity benefit, meaning that if he goes into even if he goes into rehab after the hospital, that's considered a nursing home, there's a 0-day elimination period. They're going to pay $300 every day he's in there, even if that's paid by Medicare. So this is a cash benefit. Or if he went into an assisted living where it was like Tom showed us earlier, it was $4,500 or $5,000 a month, you know, he's still going to get $9,000 paid or $300 a day on that, in addition to whatever reimbursement that he gets. So it's not relative to the cost. This thing just pays out if you spend a day in there, and it'll pay for up to 360 days, which is essentially a year, or a maximum of $108,000. Now, the home care is a completely separate benefit, and it has its own separate maximum. So when you're using the nursing home, you're not exhausting your benefits for home care, and vice versa. When you're using up the home care, you still retain all these benefits for the nursing home and the assisted living. And this is a similar cash benefit. If you're receiving home health care at a minimum standard through an agency, and you just have to have 3 visits a week from an agency, and once you've met the minimum standard and it's necessary, they're going to send you a check for $1,200 a week. So you could have a relative move in with you. You could have somebody that you're paying to stay with you at night. You can have all kinds of things, and you're just going to be sent $1,200 a week or $4,800 a month, tax-free, and you're going to be able to spend that on whatever you see fit for your care. And that's going to go on for 52 weeks or a maximum of $62,400. And this too has a 0-day elimination period. So if you broke your hip and you went to the rehab and you were in the rehab for a week or 2, you're going to collect this amount per day. Then you go home from there, you're going to collect this $1,200 a week for as long as you need care. And let's say that's, 13 weeks or 3 months, you're going to collect, about $15,000, $16,000, $17,000, $18,000 for to spend any way you want to be receiving care to let you adapt at home better. And then when you don't need the care anymore, that stops. So I don't want to get too much into the details of the policy, but this is a great alternative. That's the good news. The bad news is this is only in 30 states in DC. So people say, oh, I'm sure that it's my state is one of the 20. Well, maybe, but didn't want to go over all 30 states, but a lot of the states, this is accepted. It'll work in the District of Columbia. Now, another piece of good news thrown in there is in an additional 10 states, so now we're up to 40 states in DC, there's something similar available to this, okay? So it's a short-term care policy. It's just not this policy, which we happen to like. So now we got 40 states covered in DC, and the states that it's not available, any short-term care is not available: California, Florida, Massachusetts, Minnesota, New Jersey, New York, North Dakota, Vermont, and Washington. The regulators there don't allow these type of policies. So that's kind of why we went over this policy, and for people that want a more traditional long-term care policy, because that solution has its benefits. This one is harder to get. This one is as hard to get as that hybrid policy is. So I'll leave it at that. I wanted to show you generally what a starter plan is, but I really want to talk to you about why you want to buy this thing. And I'd really like to bring Tom in as well, so he can join in the commentary. And what I want to say is, I've been in the situation so many times with the adult children who are about my age, maybe a little younger, then sitting there with their parent who is in poor health and needing care, or maybe they've brought them in the office, or maybe they've, whatever, we're sitting with them, and then there's either the healthy spouse like mom is over there and she's in reasonably good health. She's not healthy enough to take care of dad. And then dad has a lot of money. And what dad has told all the long-term care salespeople whenever they've wandered along in the past, or the way he's kept them at bay, he says, I got a lot of money. I'm just going to pay for this when it happens. Well, now we're in that situation. And that sounds good when you're 65 to say, I'll just pay for it. I have enough money. What I'm going to take you into is the real situation where I'm sitting there. The kids have brought me in there, and I'm just trying to help them with paying for the stuff. And it is hard to sit down with dad and convince him to just come off of some of his money to pay for care from an aide that was in here 2 weeks ago. And from his opinion and mom's opinion is all she does is watch TV and yak with her girlfriends or something, which, I hope that's not what aides are doing, but that's how I've heard them described by a lot of people. But the real issue is we got the daughter, who is really the inheritor of the estate, trying to get dad to come off of, dad and mom to pay $1,000 a week, or, $1,500 a week, or $600 a week, or something, to get some help in here so his dad can stay at home. And he's completely against it because he just doesn't want to spend the money. Yeah. I want you to just talk a little bit about that situation, Tom.
Yeah. I mean, I think we see it all the time where people have the money. I mean, objectively, they have enough they could pay for the care, but they don't want to spend it. I mean, the reason they have the money is they don't spend it frivolously, at least in their mind, is they're tight with their money. They want to save it. And what ends up happening is they try to do things that they shouldn't be doing by themselves. They might fall, they might get hurt. The other spouse might try to be helping and that gets them hurt. I mean, there's all sorts of things that can go wrong when people aren't willing to bring in the care. And it's a lot easier to bring in the care when you have an insurance policy to pay that bill than coming up with it from your own money. And the other thing that we see a lot of times is people might have a lot of wealth and it might be tied up in something like real estate, for example. We have a lot of clients recently that have a lot of real estate coming in, but it's illiquid. Is to get the money out, you either have to refinance, you have to sell it. I mean, you have to pull the money out of that house somehow, and that takes time. And in the meantime, they need the care. Having this policy really just buys them time, a year, to get everything figured out. I do also want to point out the one on the right side, those short-term cares are much easier to qualify for. Not this exact policy, but something similar. I just had a client who was just diagnosed with Parkinson's, and it's still early stage. He's not needing help now. He's still doing fine, but long-term, he's looking to the future. He's like, realistically, I might need some help. And he was able to qualify for a policy like this, even with the diagnosis of Parkinson's. And so, there's a lot of people that think they're too sick to get these policies that can actually still qualify.
Well, and so my guess is that guy has plenty of money. Okay. So even without the insurance, he's going to be able to afford the care.
Right.
He's thrilled to get the insurance. And so my whole point is this: if you get in the situation, you are well-to-do, you got the money to pay for care, and you're using that as the reason for not buying the policy. I'm just thinking you can get one of these starter plans, either that one or this one, or something like it. And then that's going to give your kids a year or two to figure it out. Because I can just tell you right now, when you're 88 and you're sitting there and we have the whole scene that I straightened out, if you've been paying for this insurance all these years, you're going to be all for cashing in on it. And that's going to give your kids what they need to just get the thing rolling and try out some home health care agencies, figure out if that's going to work. If you got to go to assisted living, kind of get you there. Either one of these policies is going to pay for it. And I'm going to tell you, your daughter and son are not going to know, where should I pull the money from? How am I going to get a cash flow of 6, 8, 10 grand a month? Is this going to be from your IRA, or is it going to be from your other assets, as Tom said, from real estate? I mean, it's just not as simple to start distributing a wealthy person's money, or a moderately wealthy person's money, when they're in their 80s. You're the daughter or son, or you're a committee of the kids, and you don't really have that much experience with money, or maybe you do, and your experience is not in line with your mom or dad, or how they save and invest and spend their money and pay taxes. I mean, there's all kinds of problems that, even though you have the money, that this type of insurance solves, and buying it with a limited time frame will simply allow you to kick the can down for a year or two down the road, so you can be preparing for when this policy runs out of money. Then you're going to have to pay for it out of your own money. So with that being said, I'm Hans Scheil.
And I'm Tom Griffith.
And we both thank you very much for listening.
Thank you.